Brian Brady. I finance commercial real estate with a specific focus on hospitality properties across the United States. Um, there's been a lot, I post a lot of quotes that I do online, especially on LinkedIn. And I thought it would be useful to explain why you're not getting a rate under 6%, even though you see me post rate options at like 5 3/4. And let me explain to you why. There's basically five capital sources that like hospitality properties. The first are debt funds. Most of you, when you're contacting me, aren't looking for bridge debt. You're not looking for private money or construction money. Most of you are calling me about permanent loans for acquisition or refinance, what we sometimes call term loans, amortized over 25 years with, 5 or 10-year terms on them. Okay, fine. So who does permanent financing for hospitality properties? Well, the absolute best terms out there in terms of lowest rates are going to be from life insurance companies. And I've got a half a dozen life insurance companies who will finance hospitality properties. Their rates are going to be in the high fives right now. And that's what so many of you see and get excited about. What are the characteristics of a life insurance company loan? They're usually going to be full recourse, very low leverage. For hospitality properties, 55% or less, meaning if you're buying a $10 million hotel, the greatest loan proceeds you're going to get are about $5.5 million. They usually have a yield maintenance prepayment penalty, so you're going to be in that loan for the term. Having said that, if you have a good property and you're going to have a debt service coverage ratio that's going to be like 1.75 or greater, and you're going to be low leverage, I can get you really cheap life insurance company loans. Okay, fine. Second thing, CMBS. These are going to be kind of the highest rates on those permanent financing. The CMBS are commercial mortgage-backed securities. The reason so many people like them is they're full-term interest only, which means if you're getting a 5-year term loan, you're only going to have to make an interest-only payment. But they're usually going to price at about 250 to 300 basis points above the corresponding treasury yield. So, if a 5-year treasury is at like 3.65 and you add 300 basis points, you're going to get a rate of around 6.65. Also, you're not going to be able to get a loan unless you're buying a property that's going to be about 10 million or higher, because the lowest loan amounts that make sense for CMBS are going to be like 6 million. They'll typically some of them will go as high as 75 loan to value, but for hospitality properties, they're probably going to be between 65 and 70%. Okay, that's the other one. And the other capital source are going to be banks or credit unions. Now, these are all over the board. These are sometimes the easiest or hardest lenders to find for a hospitality property. They'll go low, they'll go all the way down to $500,000, so many of them on the loan amount. And they can be very useful because of it's relatively simple to do business with them. Their rates are all over the place. For hospitality properties, depending upon the location, they could be as low as 6%. More realistically, they're going to be in the mid 6s to high 6s. So what determines that? Well, leverage is one of them. If you have a low leverage deal, if you have a 55% loan to cost deal, you're going to buy a $10 million hotel and you're not going to borrow more than say $5.5 or $6 million. The rest you're coming in with equity. You're going to get terms that rival life insurance companies. I can usually find you a credit union loan where you're going to get 6% or 5 7/8. with either no prepayment penalty or 3% the first year, 2% the second year, 1% the third year prepayment penalty. So banks and credit unions are a really good source for hotel capital. Here's the problem. They have allocations. They're not allowed to put more than a certain amount of their loan portfolio in hospitality. And so many of them are already in Florida and Texas are already backed up on that. And so because of that, you'll see them pass a lot of times. And it's a shame. You might have a great hotel property that you're buying, and you'll just see a local credit union or a local bank. I'll show it to them and they'll say, no, thanks. We love the deal, but we just don't have the room in our loan portfolio for it. Okay, fine. That's where I could really add value to you if you're acquiring our property, because I have a network of banks and credit unions all over the country. Their leverage is typically going to top out at 75, but be careful. For hospitality properties, they're usually going to underrate the deal to a 1.35 debt service coverage. They won't go much lower than that. And whether you self-manage or not, they're going to throw a 5% management fee in there, and they're also going to put 4% aside for reserves for your PIK. So lots of times you'll hear me say, yeah, they'll go to 75, and then we underrate the deal and it comes up at like a 67% loan to cost because of those overlays that they put in the underwriting. Having said that, it's a great capital source. So when you're seeing me quote these deals, they're realistic. These are realistic quotes I'm getting. But then you come to me and say you want higher leverage, like over 70%. I'm not going to be able to get you a 5.95 rate. I'm not going to be able to get you anything that low. Because you want the higher leverage, you're going to have something in the mid sixes. Okay, fine. Finally, there's another capital source that I didn't bring up. It's banks and credit unions, but these are SBA loans. There's two types of SBA loans, 7A and 504. Typically, the leverage you're going to get on an SBA loan max is going to be about 85. I did get a quote the other day that someone said they can go to 90 on an acquisition. I'm not so sure that that's not going to get cut on me. So the characteristic of an SBA loan for hospitality property purchase is it a 504 loan, which is what I typically use for these because it's long-term permanent financing, is two loans. It's 50% of the purchase price is going to be a bank loan, and those are usually being priced in the mid sixes. And then the second lien is going to be from a certified development corporation. This is a nonprofit that works with the SBA. They issue debentures to fund their public debentures or bonds to fund the loans which they fund. The last debenture last month was funded around 5.9%. So SBA is really good. If you get, a 6% second lien and a 6.5% first, you're going to get a 6.25% cost of capital, and that's going to probably be for a 5-year term on the first lien, and then of course it's just a straight 25-year amortization on the second lien. Well, great. Why doesn't everyone do SBA if you can get that high leverage and the rates are so good? Because they can be costly. SBA loans can cost as much as 3.75% upfront, and they'll typically finance that and tack it on the loan amount. But that's a real cost of capital, right? So, in summary, the best terms are going to come from the lowest leverage. The more equity you bring into a deal, the better your terms are going to be. That's why, to answer the question, why can't I get the rates that you're posting on LinkedIn? It's because you're just not coming to the table with as much equity as some of the other people I'm talking to. Have a great Friday. I hope this cleared up some things. I'll probably reference it a lot. Have a great weekend.